In this video, I'm going to show you the ultimate scalping strategy. You will not be able to go back to retail scalping strategies after watching this video because once you see what's possible with institutional scalping, you will have access to something that is superior from a conceptual and practical perspective. The strategy I'm about to share with you allows you to profit regardless of what direction price goes. That means you can make money whether price goes up or down after you place a trade. That by itself is a massive advantage in relation to all retail scalping strategies where traders lose if they choose to be on the wrong side of the market. This simply doesn't happen in this strategy. You profit no matter where price goes next, so you don't have to speculate about the future direction of price. The other massive advantage of this strategy is that it gets better if unexpected events hit the market, no matter if it's good or bad. In fact, traders using this strategy count on the fact that chaos and turmoil will hit the market unexpectedly instead of being scared by this possibility. In summary, you can make money regardless of market direction, and you can make money from uncertainty instead of being destroyed by it. This is what we call an anti-fragile trading approach. Anti-fragility is a property of things that thrive on chaos instead of being destroyed by it. In the thumbnail of this video, there is a two-headed snake, which is an allusion to the Greek mythological creature called Hydra. The Hydra is a symbol of anti-fragility because if you try to cut its head off, two other heads grow back. In other words, it's a creature that thrives whenever something tries to destroy it. The parallel here is clear. Just as the Hydra thrives when someone tries to kill it, an anti-fragile scalping strategy gets better whenever chaos and turmoil hits the market. The advantage here lies in the fact that it's a lot easier to count on the fact that bad things will impact the market because that happens all the time. If you think this is too good to be true, I'm going to prove it to you with a practical example. This is not a trick nor a miracle. It's what happens when you learn the elegant mathematics of derivatives. Beyond that, you don't even need price charts to apply this strategy. For this example, we are going to create a hedge using stock options and stocks. The stock is the underlying financial asset, and the stock option is its derivative. A derivative is nothing more than a financial instrument that derives from another. I'm going to start by buying 10 at-the-money call option contracts that are 44 days away from expiration. Notice that the implied volatility, which is given by the Black-Scholes model, is at 22% at this moment. This is the first side of the hedge. When we buy call options, we are basically going long. Now we need to create the other part of the trade by neutralizing the long position created by the call option contracts. In order to do that, I'm going to short sell a certain number of stock shares. The number of shares depends on a lot of different factors, but we can discover that with the goal seek function in Excel. For that, we need to go to the Data tab, then What If Analysis, and then the goal seek function. A small box with three parameters will open. In the first parameter, we choose the cell corresponding to the total delta of our trade. The delta is the Greek that displays the direction or risk of our trade. We want to neutralize the delta in order to create a trade that is immune to the market direction. As a parenthesis, the delta is simply one of the partial derivatives of the Black-Scholes model. If you want to learn more about it, I have a video here in the channel called The Black-Scholes Model Explained. If you don't understand how options work at all, I also have a free options trading course in the channel. We are going to set the second parameter to 0 because we want the delta of our trade to be neutralized. In the third parameter, we're going to choose which cell in the matrix we're going to alter in order to achieve the goal of neutralizing the delta. That cell is going to be the one that corresponds to the number of stock shares we're going to short sell. By clicking OK, Excel will calculate the number of stock shares we need to short sell in order to neutralize the positive delta created when we bought the 10 at-the-money call option contracts. In this case, we need to short sell 522 shares. As you can see, the delta is now 0. In the world of derivatives, this is called a delta hedge, but make no mistake, delta hedging is not a strategy by itself. It's just a prerequisite for a volatility trading strategy. You may think that it makes no sense to buy something and then sell another, as this will produce a net zero result. That will be the case if we were using two linear financial instruments. This is where the cool mathematics of derivatives enter the scene to create an amazing effect. The underlying asset, which is the stock, varies in a linear way. but the stock option varies in a nonlinear way according to the Black-Scholes model. So if you look at the payoff chart, you'll see that the P&L in the y-axis varies nonlinearly as a function of the stock price represented in the x-axis. $45 is the price where we created the delta hedge. If price moves away from 45, it will generate a profit. It doesn't matter if it goes up from 45 or down from 45. Let's test that to see if it works. If the stock price goes from 45 to, let's say, 55, we'll notice a profit of around $3,400 in our trade. If price goes from 45 to 35, for example, we'll notice a profit around $3,800. That happens because in a hedge like this, when price moves away from the point where the hedge was made, the part of the trade that wins creates a profit that is larger than the part of the trade that loses. And that is the case no matter which direction price goes. This is what I meant when I said you can make money regardless of what direction price goes. Once again, a delta hedge is a way to avoid the directional risk of the market. We are not exposed to the market direction anymore. We are not exposed to market volatility, which is easier for a variety of reasons, but mainly because it's easier to rely on the fact that things will go out of order than trying to speculate the market direction. That's the conceptual advantage of using derivatives, which were basically invented as a risk mitigation tool. However, a strategy like this also has its risks. We are exposed on market volatility, which is represented by the Greek called vega, and we are also exposed on the erosion of options through the passage of time, which is represented by the Greek theta. To make money with a strategy like this and avoid the vega and theta risks, we need to create a hedge when volatility is low. The advantage here is that deciding when volatility is low or high is a lot easier than deciding when price is low or high, because volatility has a predictable cyclical component. This strategy is based not on one, but two ideas that won the Nobel Prize in economics, so it's one of the best things you can do in the financial markets. So instead of trying to learn smart money concepts, you should learn Nobel Prize concepts, because that's what institutional traders really do. If you think this is an interesting idea, I have written an ebook explaining the many details of this strategy from the conceptual framework to the different tactics, and how institutional traders predict volatility, which is what you need to do with this strategy. If you have any questions about the ebook, please don't hesitate to contact me at support@fractalflowpro.com. This is it for this video. I hope you are able to see the advantage of using something like this in comparison to the retail scalping strategies you see out there, which are all variations of the same flawed concept. If you like what I do and wish to support the channel, please click the like button, subscribe to the channel, activate all notifications, leave your feedback in the comment section, and share the video with your fellow traders who are suffering from the long-term consequences of retail scalping. Thank you very much for watching, and I hope to see you in the next videos. Take care.